Hello everybody and welcome to another one of IRONSHIELD Financial Planning's Fly on the Wall webinars. My name is Scott Plaskett and I'm a certified financial planner and the senior financial planner and CEO of the fee-based financial planning firm IRONSHIELD Financial Planning. If this is your first time tuning into a Fly on the Wall recording, let me quickly explain to you what this is. You're going to experience what it's like to be a fly on the wall during one of my update calls with a member of our Top Guns network. This network is my personal network of specialists. Every so often I ask a member of my network to touch base with me to bring me up to speed on the latest happenings in their area. And when they call me, I record the call so you can be a fly on the wall for that call. In today's episode, I have an update call with Charles Wilton, a portfolio manager at Raymond James Limited, a Canadian subsidiary of Raymond James Financial. Raymond James is one of the most respected investment management firms in North America. I love speaking directly to portfolio managers about their process. Process is so important to investing, and when I can get a portfolio manager to explain their process in plain English, we all benefit from this wisdom. Now, here's the call. Okay, Charles, listen, thank you very much for taking the time today to really just have a bit of a discussion about a recent disposition that's taken place in the portfolio. You recently sold Walgreens, and so I thought it was worth us just having a conversation today about the company and sort of what it was that motivated you to figure that today is the right time, or the recently was the right time to give the stock back to the market. So what I'm going to do, I'll just pass it over to you, and then you can speak to sort of your comments on Walgreens.
Okay, Scott, good. I decided to sell Walgreens, and it's as I mentioned many times, it's mostly about the price. So companies can be undervalued and overvalued depending on whether they're good companies or bad companies. It doesn't really matter. So I bought Walgreens in 2007 for $24, and it was trading well under what the no-growth aspect of the cash of the company was. So it was a fantastic buy, and there were a lot of good buys at the bottom of the market. And then we're watching it, and all of a sudden, things started coming up with Walgreens, and we started to see the earnings slip a little bit, and we started to see the companies announcing that they, for example, they don't think they can achieve their 2016 operating profit objectives, and which they made a couple of years ago. And we see the market moving up. We see the stock getting pumped up a little bit. And the valuation of the business now, and you can see there, we look at the price to economic book, and the economic book is just the no growth aspect of the cash of the company. So it is trading at 2.3 times what the business is worth. And of course, that's based on the market price. So the market is expecting huge growth for the business, which is why they're bidding the stock up and paying that much for what the actual worth of the company is. In fact, if you look over the last 5 years, what the market at $72 is saying is that Walgreens will double its annual growth rate, compounded annual growth rate, which is the last 5 years. They will double it for 26 years to be able to get at the price of $72, the value of $72. So there's massive expectation there, which they will not fulfill, and if they do, it won't be with us. And I think one of the aspects of why the company's moved up here is, there's a little bit of a thing going on now with U.S. companies called tax inversion. And what it is it's a U.S. company buys a foreign entity. In this case, Walgreens owns most of Boots Pharmacy in England. And tax inversion, there's a lot of problems with that, and we're going to see these loopholes cut. But basically what it is Walgreens owns the majority of Boots. What they can do is they can move their head office. They don't have to actually move the office, but they can move their head office to England. And all of a sudden they're paying half the taxes they are now. So they're not subjected to U.S. tax as much because they're a UK-based business. So you're seeing a bunch of companies do this. This has added some momentum to the company because the expectations are way too high. So when we look at that and what the market price is telling us, it's time to say goodbye.
Yeah, I mean, it doesn't necessarily mean it's a bad company, but it's just, it seems like it's a company that's, as you're saying, if it's 2.3 times what it's currently trading, 2.3 times what it should be trading at, why not give it back? And because because going forward, the reality is, what did you say, 26 years?
26 years.
26 years.
That's not exactly 26 years, but that's basically a rule of thumb of what the company would have to do, basically to have a market value of around $72. And it's not a bad company. Now they need some work in the business. They need some work in Walgreens. So they need some activist stuff. They need to do some things in the company. But what's most important is that the expectation is way too high.
Yeah.
Now, if the stock came down a lot for whatever reason and we got down to what's reasonable, then we could go and buy Walgreens. This is the thing about volatility in the market. We love volatility. For some reason, the inversion didn't go through or something happened, and all of a sudden the stock got really hammered, and we had a big pullback in the market and the stock drops an awful lot to get to the point that we can go and buy it again.
Mm-hmm. Yeah,
but the company can't keep up with the market expectation. This is what we say. We look for businesses that are mispriced by the public.
Yeah, no, that makes total sense. And your point's a valid one where, you indicated that if for any reason, suddenly their movement or their desire to move to the UK doesn't work out and then suddenly the stock price gets hit and it brings it back down to what you would consider, a proper valuation. Yeah, there's no reason why you can't buy it again.
Exactly. And another thing that comes in here is when you're looking at a business, and this is what we stress in terms of valuation, is we want to look at the whole company. So what we have to do is we have to bring in the unfunded liabilities or off-balance sheet liabilities,
mm-hmm.
the things that are actually not on the balance sheet. So if you look at Walgreens, the economic book value is around $63 billion. And they've got about 950 million shares. So say there's 1 million shares. So at $63, the economic book value would be roughly $63. But what you do is when you bring in the off-balance sheet leases, these are lease obligations that are paid out before shareholders. When you deduct the leases, which you need to deduct, the value of the business goes from $63 billion to $29. You have $32 billion in leases. Now, yes, leases. You need leases because you need stores. But the thing is when you add it all up together. So if we take the leases out, the stock's worth $29.
Right.
It's trading at 72. So the chances are they going to go under, or there's going to be a big problem with the leases? No. But the whole aspect is from a conservative basis, understanding valuation. So the market is expecting way too much, and if they did the deep dive and looked at what the off-balance sheet items were, which is why it's important for us to do that, which is a differentiation between us and most other people, we say forget about it.
Yeah, makes total sense. Well, that's super. Well, listen, thanks so much for just taking the time. I mean, it's always nice to know a little bit of the rationale and strategy behind why, in this case, a disposition occurred, because people might look at it and say, well, it's Walgreens, and what a great company. Why are you selling a great company? But it makes total sense when you go through the deep dive, and I appreciate you taking the time and reviewing it with us. Thank you for listening to today's call. If you require further information or have a question relating to today's call, please go to the comments section in the show notes below. Ask your question or make your comment and we'll respond directly online. If you would like to take advantage of a free, no obligation appointment, please call me at 416-626-6515. Or you can visit us on YouTube by checking out our YouTube channel, youtube.com/IronShieldCFP. Follow me on Twitter. Twitter.com/IronShieldCFP. Like us on Facebook, Facebook.com/IronShieldCFP. Or you can connect with me on LinkedIn.